What if I told you that the hottest, most successful public stock launch of 2019 wasn't a revolutionary tech giant, but a company selling fake meat? And how could a brand backed by Bill Gates and Leonardo DiCaprio, one that soared to a $10 billion valuation, collapse so spectacularly that its stock would be worth less than a cup of coffee just a few years later? This isn't a hypothetical, it's the story of Beyond Meat. On May 2nd, 2019, Wall Street witnessed a phenomenon. It was a moment that seemed to signal a permanent shift in the American diet, a sizzle that echoed far beyond the confines of the New York Stock Exchange. A company with that radical product was launching its initial public offering, and the market was ravenous. Shares of Beyond Meat, traded under the ticker BYND, had the best public stock launch of the entire year. The stock, priced at $25 per share, exploded, surging an astonishing 163% on its very first day of trading to close at $65.75. It was not just a successful IPO, it was a cultural coronation. This debut beat out technology giants like Uber and Lyft, marking the biggest and most explosive United States launch since the dot-com boom of the year 2000. The company's valuation rocketed past that staggering $10 billion. This was not a niche health food company. This was the future of protein. The smart money was all in. Bill Gates was backing it. Leonardo DiCaprio was an investor. Even Tyson Foods, one of the world's largest legacy meat producers, had put its money behind the startup. Fast forward through a pandemic and a seismic shift in economic and cultural sentiment. The date is October 2025. The sizzle has died, replaced by the sound of a company in freefall. Beyond Meat, once the darling of Wall Street and the icon of a green tech future, is now the subject of grim financial obituaries. It stands as one of the most spectacular and rapid corporate collapses in the history of the modern food industry. The company's stock, which had once soared to a high of over $230, is now trading in the gutter of penny stock territory, hovering precariously between $1 and $3 per share. The company is hemorrhaging money, slashing its workforce by 19%, then another 9%, then another 6%. It is shutting down its ambitious operations in China, a market it once saw as key to its global domination. Far from its clean, world saving image, the company is bouncing from one bizarre controversy to another. The story of Beyond Meat is a quintessential boom to bust narrative, a cautionary tale of what happens when revolutionary hype, a flawed business model, and the cold, hard realities of consumer behavior collide. The foundational problem was not just a market downturn, it was a fundamental rejection of the product by the very consumers it needed to survive. Financial data from 2022 painted a devastating picture in a 12-week period ending on October 8th, as the wider plant based category saw a troubling decline of 8%. Beyond Meat's own grocery sales plummeted by a catastrophic 21%. This disparity indicated the problem was not just with the trend, it was foundational, a crisis at the very core of the company itself. To understand how a corporate titan could fall so far so fast, one must first understand the intoxicating narrative that propelled it to such dizzying heights. This incredible ascent, the process of building all that hype, really began back in 2009, not in a test kitchen, but with a concept. It was founded by Ethan Brown, a man with a powerful vision, but notably no prior experience in the food industry. Brown's goal was revolutionary in its simplicity and its target audience. He was not interested in creating another bland, mushy veggie burger for the small, dedicated contingent of vegans and vegetarians. His goal was far more ambitious: to create a plant based meat alternative that was so indistinguishable from animal protein in taste, texture, and appearance that it would win over the most dedicated of carnivores. The primary target was never the vegan, it was the traditional, everyday meat eater. The company's mission was to craft a product that was healthier for humans, more humane for animals, and profoundly more sustainable for a planet buckling under the strain of industrial agriculture. For years, the company operated in relative quiet, a food tech startup dedicated to the complex science of replicating meat. Its team worked tirelessly to develop its proprietary product from a base of pea protein, seeking to unlock the precise combination of ingredients and processes that would mimic the sensory experience of beef. Then, in 2016, the company made its first major move, launching the Beyond Burger. But it was the way it launched that truly signaled its disruptive intent. It didn't debut in the vegan freezer aisle, segregated with other specialty items. Instead, Beyond Meat pushed to have its product placed in the one location that would force a direct comparison: the refrigerated meat case, sitting right next to packages of conventional ground beef and steaks at select Whole Foods locations. This was a psychological masterstroke. It was not presenting itself as an alternative, it was presenting itself as an equal, a direct competitor for the center of the American plate. This bold strategy soon attracted the attention of the very industry it sought to disrupt. The first and perhaps most significant mainstream validation came in October of 2016. Tyson Foods, a legacy behemoth that processes billions of pounds of chicken, beef, and pork annually, announced it was investing in Beyond Meat. The signal was unmistakable. If one of the largest meat processors in the world saw a future in plant based protein, perhaps everyone else should too. This was the ultimate insider bet, a sign that the incumbent industry was hedging against its own disruption. With this industry validation, the smart money and celebrity cachet followed, transforming the startup into a cultural movement. Bill Gates, through his investment firm, had already backed the company, lending it an air of technological and intellectual inevitability. Then, in October of 2017, actor and environmental activist Leonardo DiCaprio joined as an investor, solidifying the brand's climate friendly credentials. He was followed by other high profile names, including Snoop Dogg and legendary venture capital firms like Kleiner Perkins, which had famously backed giants like Google and Amazon. This was no longer just a food startup, It was an A-list endorsed revolution. Bolstered by capital and surging demand, Beyond Meat began a massive expansion. By 2018, the company was actively tripling its manufacturing footprint, pouring resources into its Missouri factory to triple its output, all in a desperate race to keep up with the growing hype. And that race to keep up with the hype led directly to its peak, that period of pure market euphoria and the massive mainstream push starting in 2019. By the time Beyond Meat decided to go public that year, it was riding a wave of perfect, curated narrative euphoria. The company's story was flawless, appealing to three of the most powerful consumer drivers of the modern era. First, there was the powerful health narrative. At a time when doctors were increasingly warning against the dangers of red meat, Beyond Meat offered a seemingly guilt free indulgence. It was positioned as a healthy alternative, boasting zero cholesterol and lower levels of saturated fat. A paper published by Stanford Medicine even suggested that swapping conventional burgers for Beyond Meat products could lower the risk of cardiovascular disorders. It was the burger you could eat while still following your doctor's orders. Second, there was the undeniable appeal to a generation grappling with climate change. The company's marketing brilliantly highlighted the environmental toll of rearing beef, and Beyond Meat was the solution. Its product promised to use significantly less water, less land, and produce far fewer greenhouse gas emissions than traditional livestock. Consumers could, in effect, eat a burger and help save the planet at the same time. Finally, the narrative tapped into the growing cultural consciousness around animal welfare. The rise of veganism and flexitarian diets had primed the public for a product that delivered the satisfaction of meat without the direct harm to animals. These three pillars, personal health, planetary health, and animal welfare, combined to create the ultimate feel good investment. You could make money while simultaneously feeling virtuous. This powerful narrative fueled a wildfire of market expectation. The initial bullish case for Beyond Meat, whispered by analysts and shouted by cable news pundits, was built on a simple, compelling analogy. Plant based meat would do to the conventional meat industry what plant based milk had done to the dairy industry. Investors looked at the explosive growth of almond, soy, and oat milk, which had carved out a significant market share from cow's milk, and saw a clear parallel. If plant based meat could achieve even a fraction of that disruption in the multi trillion-dollar global meat market, the upside was virtually limitless. The market data seemed to support this thesis. In 2020, total dollar sales for the meat substitute category reached a staggering $1.3 billion, representing a 46% increase from 2019 alone. The final piece of the puzzle, the move that would cement its transition from a niche phenomenon to a global staple, came in February of 2021. Beyond Meat announced it had secured the holy grail of food service, global partnerships with McDonald's and Yum Brands, the parent company of KFC, Taco Bell, and Pizza Hut. The McPlant burger was coming. Beyond Meat's products were set to be sold in tens of thousands of restaurant locations worldwide. This was it. This was the mainstream breakthrough, the final coronation. It seemed for a moment that Ethan Brown's vision of becoming a major global protein company was not just possible, but inevitable. Underpinning this meteoric rise was a business model borrowed not from the slow, methodical world of food production, but from the breakneck speed and burn world of Silicon Valley. Led by Brown, the company adopted a growth, above all operating model. The focus was on rapid, relentless innovation and capturing market share at all costs. The goal was to introduce as many new products as possible, as quickly as possible, to get in front of consumers and establish a dominant brand presence before competitors could catch up. Brown spoke openly of his ambition to turn Beyond Meat into a $40 billion revenue company. This tech sector mindset, however, prioritized speed over sustainability and scale over efficiency. It was a philosophy that would, in time, prove to be the company's fatal flaw. And that fatal flaw began to show almost immediately. The first cracks in the foundation appeared right at the moment of that supposed mainstream breakthrough, the one that was supposed to catapult Beyond Meat into every household. It was the very thing that exposed its first devastating weakness. The first major crack appeared not with a bang, but with a whimper. In July of 2022, McDonald's quietly, almost silently, ended the McPlant test in its United States markets. There was no fanfare, no triumphant press release. It was simply dropped. The reason, as industry analysts pointed out, was painfully obvious. Americans weren't buying it. The burger, which had launched with so much promise, had failed to resonate with the fast food giant's customer base. The McPlant was not an isolated incident. It was the first domino in a cascade of failures at the exact quick service restaurants QSR's Beyond Meat had counted on for its mainstream domination. The fast food plant based revolution simply wasn't happening. One by one, partnerships fizzled out, becoming a veritable graveyard of failed product tests. Dunkin' discontinued its Beyond Sausage breakfast sandwich. Tim Hortons pulled its Beyond Meat meatless range. Pizza Hut's pepper phony vanished from menus. KFC's Beyond Fried Chicken Nuggets, despite an initial surge of curiosity, failed to gain long term traction. And a high profile test with Taco Bell for a carne asada alternative went nowhere. The products were in the restaurants, but after an initial flurry of curiosity buys, customers were not coming back for more. The reasons for this catastrophic failure in the US QSR market were threefold. First, the product introduced significant operational complexity. In the high speed environment of a fast food kitchen, where every second counts, having to segregate a plant based item from animal meat on the grill was a logistical nightmare. It required separate utensils, separate grill space, and separate workflows to avoid cross contamination, slowing down the entire assembly line. Second, this complexity directly impacted the core promise of fast food speed. The US QSR market is dominated by a drive through focused culture. The extra preparation time needed for the Beyond Meat products, combined with the fact that demand was often not high enough to batch cook them ahead of time, meant that drive through lines were held up. An order for a plant based burger could bring the entire system to a halt, a cardinal sin in the world of fast food. Finally, and perhaps most fundamentally, Beyond Meat had targeted the wrong customer channel. The typical QSR customer, particularly at a burger chain, is often value driven and seeking a quick, familiar, and indulgent meal. They were not, by and large, the core, health conscious, environmentally minded consumer who was willing to pay a significant premium for a plant based alternative. The person willing to pay a premium for a health product was simply not the same person pulling into a McDonald's drive through for a $3 burger. Now, that failure at the fast food counter was, as we've seen, just a symptom. But it pointed directly to the core reasons for the decline, which were these much deeper systemic problems with both the product and the company itself. The single greatest barrier to Beyond Meat's mass market adoption, the one it could never solve, was price. In 2019, Barron's had already highlighted the issue. The plant based version was significantly more expensive than real beef, a gap Ethan Brown had battled and failed to close. This was not a small 20% premium, it was a chasm. The McPlant, for example, was priced at around $5, while a conventional burger at McDonald's could be had for $3. For the 5 to 6% of the US population who are committed vegetarians or vegans, this extra cost might be acceptable. But to make the business viable, Beyond Meat needed meat eaters to switch. And when the fake costs more than the real thing, the vast majority of consumers will not make the trade. The financial data revealed just how fatal this price gap was. Analysts pointed out that plant based meat alternatives had a staggering $4.20 price gap per pound compared to conventional meat. This was a completely different scenario from the plant based milk market Beyond Meat had hoped to emulate. In that category, the price gap was a far more palatable 31 cents per pound. Plant based milk could slot in as a mid priced product, more expensive than conventional milk, but often cheaper than organic milk. Plant based meat, by contrast, entered the market as the absolute premium, high cost option. When rampant inflation hit the economy in 2021 and 2022, this premium price point became a death sentence. As grocery bills soared, consumers cut back on experimental high cost luxury items. They reverted to their traditional buying patterns, opting for the comfort and, most importantly, the affordability of conventional proteins like chicken, beef, and pork. This created a classic catch 22 for Beyond Meat. The company desperately needed to scale up its production to achieve economies of scale and bring its prices down, but it couldn't achieve that scale because its prices were already too high for mass market consumers to buy the product. The second fundamental problem was the product itself. For all the technological wizardry, the product never truly delivered on its core promise. It did not taste as good as real meat. Consumer Reports tested the Beyond Burger and found that while it was close, it wasn't quite there. Taste tests consistently showed that while the products were improving, they failed to fully replicate the complex sensory experience, the texture, the craveability, the specific way it cooked of eating real meat. For the 95% of Americans who eat meat, close enough is simply not good enough, especially when you are paying 50 to 100% more for the privilege. The data on repeat purchase rates told the whole story. The first wave of curious consumers who had tried the product between 2019 and 2021 were not coming back for a second or third time. The novelty had worn off, and the product itself was not compelling enough to build a loyal customer base. While the price and taste were failing to win over consumers, the company's core health narrative was simultaneously collapsing. Initially, the message had been clean and powerful: zero cholesterol, lower saturated fat. But that message was soon drowned out by a new and potent counter narrative. Beyond Meat was an ultra processed food. As consumers became more educated and skeptical about how their food was made, the long chemical sounding ingredient lists on Beyond's packaging became a major liability. An ultra processed food, defined as one made from industrial components and processes you could not replicate in a home kitchen, became antithetical to the very idea of health and wellness. The traditional animal meat industry, seeing a critical vulnerability, pounced. It helped fund and promote a powerful backlash, disseminating information through social media and other channels that these heavily processed products were, in fact, not as good for you as you were being told. Beyond Meat found itself trapped. It tried to defend its products, publishing reports on their health benefits and arguing that processed doesn't automatically mean unhealthy, but the narrative had shifted. In the public's mind, the perception of a clean, healthy product had been replaced by the image of a synthetic, factory made food. This narrative collapse was amplified by a cultural and political backlash. While Beyond Meat's products are plant based, made from plants, they were often conflated in the public discourse with cultivated lab grown meat. As states like Florida and Texas began to pass bans on cultivated meat, the political rhetoric created a broader climate of skepticism toward all meat alternatives. Florida Governor Ron DeSantis, in signing his state's ban, framed it as a way of keeping global elite food out of Florida. The product became a symbol in the culture wars, derided by some as woke food. In parts of the United States, where cattle farmers represent a powerful political lobby, politicians were only too happy to align against this new age competitor. As Beyond Meat's public image was taking a beating, its market dominance was evaporating. The company's first mover advantage, once its greatest asset, disappeared as the market became crowded. Its arch rival, Impossible Foods, was fighting aggressively for the exact same restaurant partnerships and precious shelf space. More damagingly, the traditional meat companies that Beyond had once courted as investors, including Tyson, launched their own plant based lines. These legacy companies had the manufacturing scale, distribution networks, and financial muscle to compete on price, often undercutting Beyond's premium products. The result was a disaster. Beyond Meat was now losing market share, not in a growing and expanding category, but in a market that was itself beginning to shrink. And it's critical to understand that this convergence of the health narrative collapse, the cultural backlash, and the rise of competition wasn't just a series of unfortunate parallel events. They were a deeply interconnected, toxic spiral feeding into and amplifying one another. The ultra processed label, for instance, became the perfect single word weapon that tied all of Beyond's vulnerabilities together. Think about it. The company's entire premise was based on a technological solution to a biological product. It was a Silicon Valley mindset applied to the dinner plate. This food tech identity, which had been so compelling to investors, was a double edged sword. Initially, it attracted billions in venture capital from tech visionaries who saw it as a platform for protein, a scalable, replicable, and highly defensible piece of intellectual property. But for the end consumer, this very identity created a fundamental and ultimately fatal paradox. The target customer, that health conscious flexitarian looking to reduce red meat intake, was often the exact same person who was most deeply skeptical of industrial food production. This is the shopper who actively avoids big food, who reads labels religiously, prefers clean ingredients, and wants their food to be natural, whole, or ancestral. Beyond Meat, with its long scientific sounding list of protein isolates, methylcellulose, and stabilizers, was asking this exact person to trust a factory produced, highly engineered patty over a single ingredient product, ground beef. The traditional animal meat industry didn't even have to invent a new argument. They just had to point at the ingredient list. They brilliantly reframed the entire debate. It was no longer clean, sustainable, plant based protein versus dirty, resource intensive animal meat. Instead, it became natural, simple, real food versus an unnatural, synthetic, fake laboratory product. This idea of fake food was pure gold for the cultural backlash. Food, for many people, is not just fuel, it's a core part of their identity. What you eat signals who you are. This lab meat narrative allowed critics to paint plant based alternatives as an elitist project, something that global elites and out of touch tech billionaires, the same people who had famously backed the IPO, were trying to push on regular people. Eating a Beyond Burger, therefore, wasn't just a dietary choice. It became, for some, a political statement of compliance with a woke agenda. And in response, eating a real steak became a powerful counterstatement, an act of defiance, a way to signal one's identity as authentic, traditional, grounded, and skeptical of these top down cultural trends. The product was branded woke food, and in a deeply polarized America, that label is toxic for any brand seeking the mass market adoption that Beyond's valuation demanded. Into this perfect storm of consumer skepticism and cultural hostility sailed the competitors who were much better positioned to weather it. They didn't have the baggage of being the poster child for this whole controversial movement. Impossible Foods, while also a highly processed product, had a more compelling magic trick. Its narrative was built around heme, the iron containing molecule that makes meat taste like meat. It was a singular, promotable, scientific breakthrough that felt like magic, which helped it sidestep some of the factory food criticism. But the more lethal competition came from the legacy brands, the Tysons, the Hormels, and the Cargills. They didn't care about the high tech narrative or saving the planet. They saw a trend, copied the basic formula, and then used their massive existing scale to launch their own simpler, cheaper plant based lines. They didn't need to be as good as Beyond Meat, they just needed to be good enough and, crucially, significantly cheaper. They effectively hollowed out the bottom of the market, leaving Beyond Meat trapped in an untenable position. It was too expensive and fake for the mainstream and increasingly seen as too processed and industrial for the health conscious niche it had originally targeted. Worse still, these external pressures were compounding a series of catastrophic failures within the company itself. The growth above all model was proving to be a financial disaster. The push for rapid expansion had led to mounting expenses and a staggering $1.1 billion in debt. The company's cost structure had completely outpaced its sales. Internal sources revealed a critical disconnect between Ethan Brown's R&D teams and the commercialization teams responsible for mass production. Executives would allegedly show off new product prototypes that had been perfected by hand in small lab batches, generating excitement and securing orders from retailers and restaurants. But when the commercialization team received the innovation, they found it was impossible to scale up for mass production, leading to struggles, delays, and inferior products. This rush to market led to a string of embarrassing and costly product failures. A new version of dinner sausages hitting shelves in 2020 had not gone through sufficient testing and was found to sag and deform when stored vertically in packages. Customers were turned off by the appearance and new flavor, and the company eventually had to pull the product from stores. A highly publicized jerky product launched in partnership with PepsiCo in March 2022 was a financial black hole. The company admitted that the jerky, which was a key part of its growth strategy, had a complex and high cost manufacturing process that had reduced the company's gross profit by nearly $6 million in the third quarter alone. The internal chaos was palpable. The rush to market led to immense waste, with expensive equipment being purchased that was ultimately not needed, and packaging for new products being printed and then discarded because nutritional facts had not yet been finalized. Insiders pointed the finger at Ethan Brown's leadership, citing his struggle to manage the company's growth, his poor planning and prioritization, and his tendency to constantly shift the company's priorities, leading to confusion and frustration among employees. As if the operational and financial crises weren't enough, the company was then rocked by two public scandals that were almost comically disastrous. First, in September 2022, Beyond Meat's chief operating officer, Doug Ramsey, was arrested after a college football game. The charge, allegedly biting another man's nose in a parking lot fight. The irony of the COO of a company selling plant based meat substitutes taking a bite out of a human was not lost on the media, late night comics, or a skeptical public. Ramsey left the company shortly after in October. Then, just 2 months later, in December 2022, Bloomberg published a damning investigation alleging that Beyond Meat's key production facilities in Pennsylvania had serious contamination issues. The report cited unsanitary conditions that led to the discovery of mold and listeria. This was a devastating blow, striking directly at the heart of the company's remaining health and safety narrative. With all of that happening, failed partnerships, narrative collapse, internal chaos, and public scandals, a full blown financial crisis, and a painful restructuring were inevitable. The convergence of all these factors created that perfect storm. By October of 2022, the company was officially in crisis mode. Ethan Brown announced a pivot from growth above all to a sustainable growth model. In plain English, this meant massive layoffs. The company announced it was cutting 19% of its global workforce. This was just the beginning. As the financial situation worsened, another 9% of the workforce was cut in early 2025, coinciding with the announcement that the company was suspending its operations in China. This was followed by yet another 6% cut in August of 2025. The company that was supposed to revolutionize food was now hemorrhaging money and staff just to survive. The financial statements told the unvarnished truth. Beyond Meat had never been profitable, not once. Its entire existence had been subsidized by investor capital and debt. This is not always a fatal flaw for a new business if it is growing, but Beyond Meat's revenue was now in steep decline. The stock price, which had peaked at over $230 per share in 2019, was now in the single digits. The real crisis, the financial endgame, arrived in October of 2025. With cash running out and massive debt obligations looming, Beyond Meat announced a desperate debt restructuring plan. The company had taken on a significant amount of convertible debt bonds that could, in theory, be converted into stock. Now, it needed to restructure those bonds to avoid default. The solution it proposed was a debt for equity swap. Bondholders would be given newly created shares of stock instead of the cash they were owed. While this move might save the company from immediate bankruptcy, it was a brutal blow to existing shareholders. By creating millions of new shares to pay off bondholders, a move that massively diluted the value of existing shares, the market's reaction was swift and merciless. The stock crashed 56% in a single day. On October 23rd, 2025, Reuters published a comprehensive analysis with a title that said it all: Boom to Bust. Beyond Meat struggles to stay relevant. Now, you'd think that would be the end of the story. Boom to bust, case closed, right? But then we get to the really strange part, the meme stock anomaly. Just as the company's obituary was being written, something truly bizarre happened. In the final days of October 2025, Beyond Meat, the failed food tech darling suddenly became a meme stock. The surge was triggered by a combination of minor positive news, an announcement of expanded distribution at Walmart, and more importantly, the company's inclusion in a meme exchange traded fund, ETF. This was all the signal that retail traders coordinating on platforms like Reddit needed. They piled into the stock, initiating a massive short squeeze. The stock surged at one point nearly 300% in just a few days and was up over 1,000% from its all time low. But this frantic speculative surge was a phantom. It was a trading phenomenon. completely detached from the company's real world performance. This temporary stock price increase did absolutely nothing to change the fundamental underlying business problems. The company was still deeply unprofitable. Its sales were still declining. It was still failing to convince consumers to buy its expensive processed product. The meme stock rally was not a rescue. It was a fleeting, bizarre epilogue to the main story of the company's collapse. So, after all that, the boom, the bust, and that bizarre epilogue, we're left with a very uncertain future. As of late 2025, Beyond Meat is, believe it or not, still standing, but it is a shadow of its former self. The debt restructuring bought the company some time, but it did not solve its core business problems. In a bid to win back consumers, the company is attempting a hard pivot. It has reformulated its products, launching Beyond 4, a new version developed with input from nutritionists and dietitians, designed specifically to address the ultra processed criticisms and strengthen its health credentials. The company is now actively seeking endorsements from independent third parties like the American Heart Association. The marketing message is also shifting, moving away from the broad environmental message which failed to motivate US consumers and focusing intensely on the personal health benefits. But for Beyond Meat to survive, let alone thrive, it must overcome the two fundamental hurdles that caused its downfall. First, it must fix the price. It must find a way to dramatically reduce its costs and achieve true price parity with, or even underprice, conventional animal protein. Second, it must fix the taste. It must improve the product to the point where consumers genuinely prefer it, or at the very least, cannot tell the difference. This is a monumental task, and time is running out. The long term case for meat alternatives remains compelling. As the global population grows and the resource constraints of our planet become more acute, the world will undoubtedly need other, more sustainable ways to produce protein. But Beyond Meat's story serves as a powerful cautionary tale about hype, timing, and the critical difference between a good idea and a workable, sustainable business. The concept of a plant based meat that is healthy, good for the planet, and tastes like the real thing is a revolutionary one.